In 1929, there was a man on Wall Street who managed $2.5 million of fortune at the time for a man not yet 35, and people who knew him called him a financial genius. 3 years later, 70% of that money was gone. The same man went on to write the book that would teach half a century of investors how never to let that happen to them. Tonight, I want to tell you how he became both people, the genius and the nearly ruined man, and why only one of them survived to write anything at all. My name is Benjamin Graham. I taught at Columbia for 28 years. I wrote a book called Security Analysis, and if you have ever heard the phrase margin of safety, you have heard something I paid for in a currency far more expensive than tuition. Tonight, you will leave with something specific, not a stock tip, nothing so cheap as that. You leave with an understanding of a much older problem, why the very qualities that make a man rich quickly are so often the qualities that make him poor again. We will walk 3 stretches of road together. First, a boy from a poor family who rose faster than almost anyone on Wall Street, and who, if you listen closely, was actually warned once, early, in miniature, and didn't fully hear it. Second, the 3 years that came closer to erasing him than he ever admitted publicly while he was young enough to feel embarrassed about it. And third, the part I actually want you to remember what he built afterward, out of the wreckage that never broke again. Let's begin where I began. Poor. My father died before I was 10 years old. And what followed wasn't poverty in the abstract dinner party sense of the word. It was my mother taking in boarders. It was watching money used as a tool, never spoken of as a comfort. A boy who grows up like that develops one of 2 relationships with money for the rest of his life. Either he fears it permanently, or he becomes almost obsessively interested in understanding exactly how it behaves. I became the second kind. You may already be able to guess which kind you became from whatever happened to you before you were old enough to choose. In 1914, I graduated from Columbia, second in my class, if you'll allow me. One small vanity in the university offered to keep me on to teach. 3 departments wanted me: English, mathematics, philosophy. I turned all 3 down. A teaching salary would not support a widowed mother and 2 younger brothers, and that year I needed something faster. So I went to Wall Street. My first job at a firm called Neuberger, Henderson and Loeb paid $12 a week. I was a runner. I carried securities and checks between offices, and in whatever hours were left, I wrote descriptions of bond issues nobody important had asked me to write because I wanted to understand what I was carrying, not merely deliver it. Here is where the arithmetic of my life starts to get interesting, and I want you to slow down with me here, because the shape of this number is the whole lesson of this first stretch of road. $12 a week in 1914. By 26 years later, at the age of 26, I had been made a full partner of the firm on a salary near $50,000 a year. That is not a gradual climb. That's a man being lifted by an elevator, not a staircase. I want to tell you exactly how the elevator started moving because it matters for what comes later. In August of 1915, a year into that first job, I learned that a mining holding company called Guggenheim Exploration was about to dissolve and hand its shareholders stock in the mines it owned underneath. I sat down with the numbers. This was the first time in my life I did this kind of work purely because I wanted to, not because anyone had assigned it to me, and I found that the pieces added up separately were worth more than the whole was trading for, about $7 more per share against a price under 70. I bought the shares. I sold short the underlying mining stocks to lock the difference in place so the profit didn't depend on which direction the market moved next, only on the math being correct. The math was correct. It worked exactly as I'd calculated. I was 21 years old, and I had just discovered something that would define the rest of my working life, that a careful man with a pencil and enough patience can sometimes see value sitting in plain sight that the market, in its noise and its hurry, has simply failed to add up correctly. You'll notice I call that discovery a beginning, not an ending. Most stories about a young man's first success stop there, as if the lesson were complete. Mine wasn't. Because success, especially early success, has a way of teaching you the wrong lesson just as easily as the right one, and I want to tell you now about the wrong lesson I very nearly walked away with because it's the part of my life almost nobody asks about. And it happened a full 12 years before 1929 in miniature, as though the universe were rehearsing the larger disaster with me first to see if I was paying attention. One of my old professors at Columbia, a kind, frugal bachelor named Algernon Tassin, heard about the Guggenheim trade and asked me to manage some of his savings, about $10,000, everything he had. We agreed to split whatever profits or losses came of it evenly between us. The account did beautifully at first. I remember feeling at 23 that I had found not just a skill, but a kind of certainty. Then, beginning in the autumn of 1916 and running through most of the following year, security prices went into a long, grinding decline. The peace scare, then America entering the war. Tassin's account, like nearly every account on margin in those years, was called for more collateral I didn't have. I had used some of my own share of the early profits to buy into a phonograph shop of all things, and the money simply wasn't there to put back in. The account froze. I owed a debt against it I had no way to repay, and my management of a man who had trusted me with everything he owned had, in my own words at the time, failed abjectly. I remember spending one of my lunch hours that year walking in circles around the financial district in what I can only describe as bleak despair. 23 years old, and already I had done, on a small scale, to a man who trusted me almost exactly what the entire market would do to thousands of people, myself included, 12 years later, at a scale I could not yet imagine. I want to pause here and let that sit for a moment, because I think it's the most important fact in this entire first stretch of the story, and it's the one detail people who admire the later, cautious Graham, almost never hear about. I did not walk into 1929 as an innocent. I had already been warned. Not by a book, not by a lecture by my own hands, in 1917, in a small enough disaster that I could absorb it, apologize for it, and eventually make my old professor whole again over the following years. The warning was real, and I still, 12 years later, built a much larger version of the identical mistake, because the warning had been small enough to survive, and surviving it, I think, quietly taught me the opposite lesson from the one it should have. 2 years after that, in 1919, it happened again in a different costume. A colleague let me in on a new stock, a company promising a revolutionary process for retreading automobile tires, of all things, called Savold Tire. My initial stake returned 3.5 times its value within a week. Flushed with that, when a second offering came along from an affiliated company, I gathered $60,000 from myself and a small group of investors, a sum that, in today's money, would be well over $1 million, and sent it in. The promised trading day arrived. Trading never began. The entire operation collapsed into what I can only call a swindle, run by a promoter who had, in fact, been quietly diverting the money to other purposes the whole time. I remember the blue shirt and the expensive cufflinks he wore to the meeting where our small committee confronted him. We managed, through considerable effort, to recover about 33 cents on every dollar we'd put in. Here is the arithmetic of those 2 years, laid plainly. One client's trust nearly destroyed through my own carelessness with borrowed money, and $60,000 of capital handed on nothing more than excitement and a colleague's tip to a man who turned out to be running an elaborate fraud. And here is the psychology which I want to name separately, the way I'll keep doing throughout tonight, because the two are never the same thing, even when they arrive in the same year. The arithmetic said I had been reckless and, in the second case, simply gullible. The psychology said something quieter and more dangerous, that these were the ordinary cost of doing business on Wall Street, tuition paid early, lessons a young man survives and moves past. I did not yet understand that a lesson survived is not the same thing as a lesson learned. Sometimes it's closer to the opposite. Surviving a small fire can make a man careless around a larger one, because some part of him now believes, without ever quite saying so, that he knows how fires behave. And it kept accelerating, that elevator, straight through the 1920s. In 1923, I left Neuberger, Henderson, and Loeb to strike out on my own. In 1926, I formed a new investment pool with a partner, Jerome Newman. We called it the Benjamin Graham Joint Account. By January of 1929, that account held $2.5 million. My own personal income, around the same period, had climbed past $600,000 a year. Sit with that figure for a moment. Translate it into money you'd recognize. Something in the neighborhood of $10 million annually for a man not yet in his mid-30s, who had started 15 years earlier running errands for $12 a week and who had already once watched a much smaller version of ruin up close. Now, the arithmetic tells you one story. The psychology tells you a very different one. And this distinction is one I'm going to keep returning to tonight, because separating the two is, in my opinion, 9/10 of what it means to think clearly about money. The numbers say talent, discipline, an unusually early gift for reading a balance sheet the way other men read a newspaper. The psychology says something else entirely. It says a man who rises that fast, that young, and who has already survived his own small collapse once, without it costing him everything, begins, quietly, almost without noticing it happened to him, to believe the rise is who he is, rather than something that happened to him under a particular set of conditions, conditions that had already shown him once exactly how they could turn. I signed a 10-year lease that same year on a duplex apartment at the Beresford. 2 full floors, 19 and 20, at $11,000 a year, a genuinely extravagant sum for a home by any honest measure for a man my age. There was a valet on staff whose duties included a daily massage. I moved in during October of 1929. You may already sense where this is going. Before I tell you what happened next, let me give you the picture underneath the confidence, because a rising man rarely sees the structure he's standing on. He only feels the rising. My fund, like nearly every fund on Wall Street in those years, carried borrowed money, leverage. By some accounts, close to half the capital in the account at points wasn't strictly mine or my investors at all. It was borrowed on the entirely reasonable assumption, by the standard of every year since 1921, that the market would keep rising long enough to pay the loan back with room to spare. Here's a picture that might help you hold this. Borrowing against a rising market is a little like borrowing an umbrella on a bright, cloudless day. You don't think of it as danger. Why would you? The sun is out. You only discover when the sky finally turns that the umbrella was never yours to keep, and someone is going to want it back at the exact moment you need it most. I did not know in the summer of 1929 that the sky was about to turn. Almost no one did. Or let me put that more honestly, almost no one who mattered believed it enough to act on it. I was 35 years old. I had 2 floors of one of the finest buildings in Manhattan, and a valet and a professor I'd once nearly ruined, who now by then considered me the man who'd built his modest fortune back up again. By every visible measure, I had already won, twice over, once through skill and once through recovering from my own worst mistake. That second victory, I think now, was the more dangerous one. It let me believe the first small disaster had made me safer when really it had only made me experienced, and experience is not the same thing as immunity. And that specific feeling, the feeling of having already won, is the most expensive feeling in finance. Far more dangerous than ignorance, because ignorance at least keeps you cautious. Confidence removes the caution and leaves you standing there exposed without even noticing you're exposed. Here's a real question before we move on. One I've never fully answered to my own satisfaction at 70 years and more into thinking about my own life. Is speed itself the danger, or is it what speed does to a man's judgment about his own limits? I don't think you can fully pull those two things apart. I'm not sure I've ever fully pulled them apart in myself. Hold on to that question. We're going to need it later. You're going to need it later, whatever your own version of speed happens to be. Because in September of 1929, the sky turned. I remember the summer before it more clearly than I remember most of what came directly after, and I think that's because the summer felt so entirely ordinary. My fund had shown only a modest gain in the first half of 1929, a a fact that looking back with the particular clarity only regret provides, should have troubled me more than it did. It didn't. Nothing about that summer felt like an ending. Then, beginning in September, the market did something with no precedent in the memory of anyone then living. Between the 3rd of September and the 13th of November, 10 weeks, the Dow Jones Industrial Average fell from 381 to 199, just short of a 48% collapse in 10 weeks. Millions of shares changed hands on the worst days. The ticker tape ran so far behind actual trading that men were selling stocks whose prices, by the time the tape confirmed the sale, had already fallen further still. Exhausted clerks were sleeping in the offices at night just to keep the paperwork from collapsing under its own weight. My own fund closed out 1929 down 20%. And I want to be honest with you about how that landed at the time, because it explains everything that came after. People around me that winter called it a triumph. 20% against a market that had fallen nearly half. I was, for a few months, referred to more than once as a financial genius for having lost so comparatively little. I half believed it myself. That belief was the single most expensive mistake of my professional life. More expensive in the end than the debt to Professor Tassin. More expensive than the $60,000 lost to a man in a blue shirt. Because this time the confidence had an entire winter of flattery behind it, and flattery, I've come to believe, is nearly always more corrosive to good judgment than outright loss ever is. Loss at least announces itself as an enemy. Flattery arrives dressed as a friend. Because 1929 wasn't the crash. 1929 was the opening scene. What followed 1930, 1931, the first half of 1932 was the actual disaster. The slow, grinding 3-year collapse that the word crash doesn't really describe, because a crash implies something sudden. What I lived through was closer to a long illness. 1930 was, in my own later words, by far the worst year in the 33-year history of my career managing money. We lost 50.5% that year alone. Not because I had learned nothing from 1929. I had already covered most of our short positions, which in hindsight was its own kind of overconfidence, a belief that the worst had already passed. It hadn't. 1931 brought another 16% loss. By the middle of 1932, the Dow itself had fallen to somewhere near 41.89% below its 1929 peak. Almost 9/10 of the value of the American stock market gone in under 3 years. My own cumulative loss from the start of 1929 through the bottom in 1932 came to 70% of that proud $2.5 million of capital I'd been so quietly proud of just 3 years earlier. 2 years into that stretch, in 1927, before the crash had even begun, while I was still, by every outward measure, winning, Hazel and I lost our firstborn son, Newton, to a childhood infection. He was 8 years old. I mention this not because grief and financial loss belong in the same ledger. They don't, and I'd never suggest otherwise, but because I want you to understand that the man walking into 1929 wasn't simply an overconfident financier. He was also, quietly, still carrying that. A household can only absorb so much weight before something in it begins to give, and mine, over the years that followed, gave in more than one place at once. Now let me separate this out loud for you, the arithmetic from the psychology, because they are not the same wound, and treating them as one is, I think, why so many people never fully recover from a period like this, even after the money itself comes back. The arithmetic, cold and simple. 70% of the capital, gone. That part is a number. Numbers can be measured, tracked, eventually rebuilt through return on whatever capital remains. Painful, but mechanical. The psychology is a different animal entirely, and no mathematics I know of fully accounts for it. My partner Jerry and I made a decision in those years that I still think about, even now. We kept paying our investors their regular quarterly distributions, even as the fund's value collapsed around us, because we knew what that money meant to the people who had trusted us with it. These weren't wealthy men playing with surplus capital. These were friends, relatives, acquaintances, ordinary people who had handed us their savings One of them came to us in genuine anguish, needing his funds for obligations elsewhere. And a friend told me afterward that this same man, an imperturbable, fighting sort of man, not given to displays of feeling, had broken down in tears once he understood how much of his fortune had simply vanished. Continuing those distributions out of loyalty cut what remained of the fund down to only 22% of its original size by the end of 1932. That was arithmetic and psychology acting on each other at once, a decision made from decency that made the numbers worse. I would very likely make the same decision again. But notice something. It wasn't the market that made that choice. That was mine. My marriage in those same years came under a strain it never fully recovered from. I don't think it's an exaggeration to say that watching a man's public identity as a genius collapse in private, month after month, for 3 straight years, on top of a grief neither of us had ever fully set down, asks something of a household that not every household survives. I want to describe what an ordinary day actually felt like in those years, because the percentages I've been giving you, honest as they are, can make the experience sound almost abstract, and it was the furthest thing from abstract while I was living inside it. A margin call does not arrive as a single dramatic letter. It arrives as a phone call, usually in the morning, from a broker whose voice you've come to recognize by its particular tone of forced calm. He tells you the collateral behind a position has fallen below the required level overnight, and you have until a specific hour, sometimes the same afternoon, to post more capital, or the position will simply be sold out from under you at whatever price the market happens to be offering in that hour, regardless of what you believe the security is actually worth. You spend that morning doing arithmetic that has nothing to do with intrinsic value and everything to do with survival, which accounts still have anything left to pledge, which relationships can be asked one more time for help. Hazel returned to teaching dance in those years to help make ends meet at home, which she had not done since before we were married. I sold personal possessions I'd bought during the flush years without a second thought, and thought about each one for a long time as I sold it. Friends who had fared somewhat better lent us money quietly, the way friends do when they suspect a public request would embarrass you more than a private one. None of that appears in the percentages. The percentages tell you what happened to the capital. They don't tell you what it does to a man to spend 3 consecutive years unsure, most mornings, whether that particular day would be the one the phone call finally came for good. One more picture for you, because the mechanics alone don't capture what those 3 years actually felt like from inside them. It's the difference between a house built quickly on sand and one built slowly on rock. The sand house goes up fast. You can move in within a season, admire the view, invite your friends over. But sand shifts. It doesn't announce when it's shifting. You simply notice one day that the walls no longer meet the way they used to. And by then, the shifting has usually gone further than you'd like to believe. A house on rock takes longer. It costs more early on, in patience, if nothing else. But rock doesn't care what the weather does. I had built, without quite realizing it, an entire financial identity on sand. And I want to be precise about this because it's easy to romanticize in hindsight. It wasn't only the leverage. It was the belief, formed a full decade earlier and never properly examined, that surviving a small collapse with Professor Tasson's money had somehow inoculated me against a larger one: fast money, fast trust, fast confidence in myself that turned out to have never been fully earned, only untested at the scale that mattered. So here's the question I promised you at the midpoint of tonight's story. Sit with it honestly, the way I had to, for years that were considerably harder than anything I've described so far. A man loses 70% of everything he's built by the age of 38, and this is not, in fact, his first such loss, only his largest. Some men, having survived that, spend the rest of their lives afraid of the market, permanently cautious, permanently small, unable to trust their own judgment again. Others double down, chase the loss, and lose the rest trying to prove the first loss was a fluke. What turns a nearly ruined man, a man who had already been warned once in miniature and hadn't fully listened into one, who never has to rebuild from zero a third time? The honest answer isn't inspiring in quite the way you might expect. And I think it's important to say that plainly because I distrust any recovery story that sounds too clean. Part of what saved me wasn't virtue. It was structure. Under the compensation arrangement Jerry and I had set up for our fund, we earned nothing, not $1 from managing the account until we had fully repaid our investors' losses. Sit with that for a second. My own financial recovery was by design chained directly to theirs. I couldn't quietly move on while they stayed underwater. The arithmetic of my own survival depended entirely on solving theirs first. That forced my hand in a way pure willpower probably never would have. In 1932, in the depths of it, I began writing a series of articles for Forbes, arguing against nearly every prevailing mood on Wall Street that stocks had fallen so far below the actual liquid value of the businesses behind them that buying them had become, by simple arithmetic, one of the more reasonable things a careful man could do. Not because I felt brave, because the numbers said so when I actually sat down and did the work rather than trusted my feelings about the market. This is the same law again, and I want to name it directly because it's the single idea that separates what I did in 1932 from what I'd done in 1929 and from what I'd done at 23 with Professor Tassin's savings and at 25 with the tire promoter's fraud. In each of those earlier moments, I let arithmetic and psychology blur together without noticing good numbers, or someone else's excitement made me feel invincible, and the feeling of invincibility was allowed to influence decisions the numbers alone never justified. In 1932, for the first time in my life, I forced the two apart deliberately, almost as a discipline rather than a mood. Here is what the arithmetic says. I would tell myself, this business's cash and receivables alone are worth more than the entire market is charging for the whole company. That part the arithmetic can settle cleanly, without opinion, and then separately, out loud to myself. The rest, whether the market agrees with me this month or this year, no mathematics will explain that. That's the psychology of other investors, not a fact about the business. And I was no longer going to let their fear masquerade as information about value. 1933 arrived. By most accounts, one of the very worst years of the Depression for the country as a whole, bread lines, bank closures, a quarter of the workforce without work, and in that year, of all years, my fund earned a 50% profit, not despite the wreckage, because of it. The businesses I'd identified in 1932 as absurdly cheap were still mostly the same businesses. The arithmetic hadn't changed. What had changed was that a little more of the market's fear had burned itself out, and prices had begun slowly to catch back up to what the numbers had said all along. By 1935, we'd recovered fully every dollar lost between 1929 and 1932. But I want you to be careful with me here, because full financial recovery isn't actually the story I came to tell you tonight, and it would be a disservice to end on the money alone. The money came back. I was never mentally quite the same man who'd signed that 10-year lease on the Beresford duplex in 1929, and I don't think that's a loss. I think that's the entire point. Through those same years, quietly, alongside the fund, I'd been teaching in the evenings at Columbia, a course I'd started in 1928 before the crash, almost as a side interest. I want to tell you something about that classroom, because it turned out to matter more than I understood at the time. Teaching a room full of skeptical, intelligent young men forces a kind of honesty that managing money in private never quite demands. You cannot bluff a room. If your reasoning has a hole in it, 20 pairs of eyes will find the hole before you finish the sentence. Working out loud, in front of students, which of my instincts were actually grounded in arithmetic and which were merely inherited habits from a more careless decade, that process did as much to rebuild my thinking as any single trade did to rebuild the funds. Capital. Years later, one of the young men who sat in those classes, a student by the name of Warren Buffett, would go on to call the ideas I taught there the foundation of everything he built afterward. I mention that now only to say whatever discipline I found in the wreckage of the early 30s, it turned out to be teachable. That, more than any return figure, is the part I'm proudest of. In 1934, working from those same lecture notes, I published a book with a former student of mine, David Dodd. We called it Security Analysis. At the center of that book sits an idea I hadn't fully possessed, not in any way I could have argued with real conviction before 1929 took it from me and made me pay full price to learn it properly. We called it the margin of safety. Picture this before I give you the mechanics, because the picture is the part worth keeping. An engineer building a bridge doesn't design it to carry exactly the maximum weight he expects to cross it. He designs it to carry considerably more, sometimes 3 times more, not because he expects a disaster, but because he's honest about his own limitations. He knows his estimate of the maximum load could simply be wrong. The safety margin isn't an insult to his competence. It's an acknowledgement of it, a recognition that competence and certainty are not the same thing, and only a fool builds as though they were. That's what I'd failed to build into my own thinking before 1929. And if I'm honest with you, what I'd failed to build in 1917 with Professor Tasson's money, and again in 1919 with the tire promoter. I was, by most technical measures, a genuinely gifted analyst from a very young age. I could read a balance sheet as well as almost anyone on Wall Street by the time I was 21. What I hadn't built for the better part of 2 decades was a margin between what I believed and what I was actually certain of. I'd let a very good analytical mind operate again and again without the humility that ought to walk alongside it. Let me make the idea a little more concrete, because I don't want it to stay only as a picture of bridges and trucks. Suppose you've done careful work on a business and concluded with real confidence that it's worth around $100 a share. The undisciplined investor buys at 95 because 95 is less than 100 and the arithmetic technically favors him. I would ask you to wait instead for something closer to 60 or 70 at the outside. Not because your $100 estimate is likely wrong. In any particular case, it may well be exactly right. It's that estimates of value are never as precise as the arithmetic used to produce them makes them feel. Every valuation carries assumptions buried inside it about future earnings, about how a business will behave in conditions it hasn't yet faced, about the competence of management you've never actually watched make a hard decision under pressure. Buying at 60 against an estimate of 100 gives you room for your assumptions to be wrong by a wide margin and still come out ahead. Buying at 95 gives you almost no room at all. You are betting, whether you admit it to yourself or not, that your estimate is essentially perfect. I had bet that way again and again in the years before 1929 without ever quite phrasing the bet to myself in those terms. The margin of safety is, at its core, nothing more exotic than refusing to make that particular bet twice. That's what I actually taught. Most evenings in the Columbia classroom, I mentioned not a secret formula, but this single, almost embarrassingly plain habit of leaving distance between belief and certainty, applied patiently, security by security, year after year. Most of the young men in that room wanted something cleverer. I understood the impulse. I had wanted something cleverer myself, once at their age, standing on the trading floor with a fresh discovery in mining stocks that felt for a little while like a kind of magic. It wasn't magic. It was arithmetic, applied honestly and left with enough room to survive being occasionally, inevitably wrong. After 1932, I never made that mistake again, not in the same form at least. I swore off large-scale leverage entirely. In 1936, Jerry and I formed a new partnership, Graham-Newman Corporation, built from the ground up around margin of safety as a working principle rather than an ornament by businesses only when the price leaves you enough room to be somewhat wrong about the future and still come out fine. That firm ran successfully into the 1950s, through wars, through recessions, through at least one more serious market scare in 1937 that tested whether the lesson had actually taken hold or merely sounded good in a book. It had taken hold. Over the following 2 decades, Graham Newman compounded at a pace that would have seemed impossible to explain to the 35-year-old man in the Beresford duplex, not because the returns themselves were larger than what that younger man had once produced in his best years, but because for the first time they arrived without the accompanying terror of not knowing how far a bad year might go. That, I've come to believe, is the actual difference between speed and durability. Speed asks how fast you can go. Durability asks a quieter, less flattering question. How much can go wrong before you're finished? I had spent the first half of my career answering the first question extremely well, and the second half of it answering the far more important one. I want to tell you about one more investment before I close, because it complicates everything tidy I've just said, and I think the complication is worth more to you than a clean ending would be. In 1948, an insurance company called the Government Employees Insurance Company, GEICO, most people came to call it, needed a buyer for a large block of its shares. Jerry and I looked at the business, liked what we saw, and did something I had spent nearly 2 decades telling students and readers never to do. I had built an entire rule around never putting more than about 5% of the partnership's capital into any single company. That was the whole architecture of the margin of safety applied to a portfolio. Not just to one stock, diversify enough that no single mistake, however careful the analysis behind it, could sink the whole enterprise. For GEICO, we broke that rule almost in half. We put something close to a quarter of the partnership's entire capital into that one company. I want you to sit with the irony of that for a moment, because I certainly have, many times over the years since. The same man who had built his life's work around discipline, around never letting one position carry more risk than the whole portfolio could absorb, looked at one insurance company and set that discipline aside. Here's what I'd say in my own defense, and I offer it honestly rather than as an excuse. By 1948, the margin of safety wasn't simply a rule I followed. It had become a way of seeing. And when you've trained your eye long enough, you occasionally see something so unmistakably undervalued that the ordinary rules governing position size start to feel less like protection and more like habit. That is a dangerous thing to believe about yourself, and I want to be honest that it is precisely the kind of thinking that had once cost me a professor's savings and very nearly my own fortune. The difference this time, and it is a real difference, though a narrow one, is that the conviction came from 20 years of arithmetic discipline, not from 20 months of a rising market flattering my judgment. The investment worked. It worked in a way that frankly dwarfed almost everything else the partnership had done across 3 decades combined. By 1972, that original position, worth about $712,000 when we bought it, had grown to something in the neighborhood of $400 million. I said once, years later, with more honesty than modesty, that after that investment, we seemed to be very brilliant people. I want you to hear the irony in that sentence the way I intended it. Brilliance in this business is very often just discipline that happened to meet a genuinely rare opportunity at the right size and the right moment. Mistake the meeting for the discipline alone, and you're back to being the young man in the Beresford duplex, mistaking a favorable wind for a talent for flying. One of the young men who sat in my Columbia classroom in those years, the same student I mentioned earlier, later built an entire second fortune of his own, partly by following GEICO's story forward long after Jerry and I were required by regulation to distribute our shares to our own investors rather than continue holding the company ourselves. I don't tell you this to claim credit for what he built afterward. That was entirely his own doing, and considerable doing it was. I tell you because I want the lesson of GEICO to stay a genuinely complicated one in your mind rather than resolving too neatly. Discipline built the platform. An exception to that same discipline produced the single greatest return of my career. I have never fully decided, in all the years since, whether that fact undermines everything I taught, or whether it simply proves that even the soundest principles need, on the rarest of occasions, a mind experienced enough to know when it is actually looking at a genuine exception rather than merely wanting one to be true. I suspect it is closer to the second, but I hold that suspicion carefully the way you should hold any belief that happens to be extremely convenient for you. I want to close now on something other than a number, because closing on a number would betray everything this story is actually about. I was in 1929 extremely intelligent, extremely well-trained, and almost entirely undefended against my own confidence, despite having been given 12 years earlier a smaller and more survivable version of exactly the same lesson. Those qualities can coexist in the same man for a remarkably long time before reality arrives to settle accounts, and I don't say that to excuse what happened. I say it because most people quietly assume financial ruin is something that happens to careless or foolish people, and in my direct experience, that assumption is simply false. It happens to careful people, too. It happened to a careful person twice in miniature before it happened to him once enormously. The moment they stop applying the care to themselves and start applying it only to their analysis of everything else, that's the moment the ground gives way, regardless of how sharp the mind standing on it happens to be. Here's what I'd ask you to sit with tonight, whatever your own relationship to money happens to be. Somewhere in your life, not necessarily in a stock, maybe in a business, a relationship, a decision you've made about your own limits. There is very likely a place where a good run has convinced you the run itself is who you are, rather than something that happened to you under conditions that won't last forever. And if you think back honestly, you may even find, the way I eventually did, that you were warned once already in a smaller and more forgivable way and quietly filed the warning under experience rather than under danger. I know that place intimately. I built a duplex apartment on it once, 10-year lease, October of 1929. But I'd also, in a much smaller room, at 23 years old, already walked in circles around the financial district in despair over exactly the same mistake, made small enough that time to survive. I don't say any of this to suggest that speed is itself the enemy, or that ambition needs apologizing for. I was ambitious at 20. I was still ambitious at 80. Ambition built the elevator that lifted a $12 a week runner into a partner's office by 26, and later it walked into a devastated market in 1932 and bought what almost no one else would touch. What I'd ask you to distrust isn't ambition itself. It's the particular quiet moment when ambition stops checking its own arithmetic against its own confidence and simply assumes the two have always agreed they hadn't in my case. Not in 1917 with a professor's $10,000, not in 1919 with a promoter's blue shirt and cufflinks, and not in 1929 with $2.5 million and a decade's lease on a view of Central Park. The size of the mistake grew each time. The shape of it never changed at all. The fault, I've come to believe, is very rarely in the market. The market does what markets have always done. It swings further than reason would predict in both directions because it's made of people, and people are not reasonable creatures even when they're extremely intelligent ones. The fault, more often than not, sits closer to home than you'd like to believe. Not in our stars, to borrow a line older than anything I've written, in ourselves. I think about Bob Maroney sometimes still, the investor I mentioned earlier, the fighting Irishman who broke down once he understood what had happened to his savings. I never forgot that. Not the fact of his loss, which was, in the arithmetic sense, a small piece of a much larger collapse. What I never forgot was what it cost a proud, composed man to admit out loud to a friend that he had trusted the wrong person with the one thing he couldn't afford to lose. I think part of what I built afterward, the discipline, the rules, the almost stubborn insistence on leaving room to be wrong, was less an intellectual achievement than an attempt to make sure I never had to watch that particular thing happen to another Bob Maroney if I could possibly help it. Some lessons get learned in the arithmetic. That one I learned entirely in his face. What I actually built in the years after 1932, more than the book, more than the returns, more than the reputation that came later, more even than the classroom full of young men who carried the idea forward long after I'd stopped teaching, was a habit of leaving myself room to be wrong. That habit isn't glamorous. It will never make anyone rich quickly, and I want to say that plainly because plenty of people come looking for the fast version of what I learned, and the fast version doesn't exist. It is, I'm fairly convinced, the only kind of wealth that doesn't eventually demand you build it twice, or in my case, 3 times, if you count the small rehearsal nobody ever asks me about. And the one large, deliberate exception I made for an insurance company in 1948 and got away with. That last part matters, and I don't want to hide from it in these closing minutes. I got away with it. I broke my own rule, and the market rewarded me anyway, magnificently. I want you to hold both of those facts at once, because most stories about discipline prefer to leave out the part where discipline gets suspended and nothing bad happens. Sometimes nothing bad happens. That's exactly why the rule has to exist on the days when you're not tempted to break it, because you cannot tell, standing inside the decision, which kind of day you're having. I could tell with GEICO only because I'd already spent 20 years training the part of my mind that tells the difference between conviction and excitement. Most days, most people cannot yet make that distinction reliably. I include the younger version of myself in that. I include, some days even now, the older one too. I was a financial genius once, briefly, in the winter of 1929. I have never entirely trusted that word again, and I mean that as the highest compliment. I know how to pay myself. If tonight's episode was useful to you, the most helpful thing you can do is leave a rating wherever you're listening and follow so the next chapter finds you automatically. New episodes on Benjamin Graham's life and principles arrive regularly. We'll see you in the next one.